Topic 10, completing the audit and audit reporting. I think it's topic 17 or 18. And we'll also be covering the audit process and completing the audit. So this week we're really going to talk about the last few steps of the audit process, okay? So this week is good for 3 reasons, right? First reason is it's pretty simple content, okay? Not a lot of, not very heavy on the definitions or the concepts, so it should be relatively easy to understand. Second, this will definitely be accessible in the exam, okay? So audit opinions is one of those judgment-based topics that requires, that we test very often, because it's one of those things we want you guys to have a very firm grasp of the underlying nature of audit opinions. And last but not least, this is the final week of content, so I'm sure we're all very excited. So next week is revision, and then that should be it for the semester. Okay, so let's jump straight into it. So this is a summary of the audit phase. So we start by reviewing for contingent liabilities. We then look for subsequent events that happen after the balance date end. We accumulate final evidence. We evaluate results. We issue the audit report that will have the opinion as to whether or not the financial statements are correct or not. And we want to communicate with the audit committee and management as to our findings on the audit. Okay, so that's going to be the basis of half today's lecture. Okay, so learning objective 1 is to design and perform audit tests related to the presentation and disclosure audit objectives. Okay, so our substantive and test of controls, they provide evidence on our transactions and balances. Okay, that will make up the tests that we have on our balance sheet, or make up the numbers on our balance sheet, and the numbers on the income statement, okay, and any other financial statements accompanying. So what we want to do with presentation and disclosure tests is ensure that the information on the financial statements, right, that being the notes that accompany the financial the reports and the presentation of the report, we want to make sure that is correct as well, right? That is consistent with what is expected of management when it comes to preparing the annual report. Okay, so we're concerned about the annual report as a whole, rather than just the accounts in the balance sheet and income statement. Okay, so at presentation disclosure tests, we want to provide evidence on each of the assertions as well. So if we review debt contracts to determine that accounts receivable are pledged as collateral, this would be an occurrence test for presentation and disclosure, because we want to make sure that the disclosures we've made in relation to accounts receivable being used as collateral on the debt contract, that has actually happened. So we want to make sure the debt contract reflects that. If we want to use a disclosure checklist to determine that all required disclosures have been made, that would be a completeness test. We want to make sure that management have included all relevant disclosures, right? A completeness test. If we wanted to review the financial statements to determine the classification of assets are correctly grouped as either current or non-current, that would be a classification test in presentation disclosure. Right? Our balance-related audit objectives have ascertained the correct number. Now all we want to do is make sure that they've been correctly categorized as current or non-current in the financial statements. And last but not least, we might want to reconcile amounts in long-term debt footnotes to the working papers. So this is to ensure that whatever number we've reported on the financial statements, that is consistent with what we found in the audit. And that would be a valuation type test. Yep. The mic. All right, let me see. How does Amanda usually do this? Sorry? So I just stand here?
No, Amanda has the mobile.
I have this. Wait, maybe it's not working. She has the yeah. My one doesn't quite seem to be working. All right, so I'll just stand here for the rest of the lecture then. I like to move a bit, but yeah, okay. So these are the presentation disclosure-based tests we want to conduct. Okay, so learning objective 2 is to review for contingent liabilities and commitments. Okay, so contingent liabilities, are very different to the liabilities we record on the balance sheet, right, for several reasons. So, like a liability, it's a future obligation, meaning we're expected to make a payment in the future. However, it's for an unknown amount, meaning we're not too sure what it's worth at the moment. And importantly, how much we are expected to pay is, let me find a good color, is conditional on some future event. Okay, so that's a contingent liability. We have a liability depending on some sort of future outcome. So an example of this might be a legal action for infringing a patent. Okay, so for instance, Samsung decide they want to create the Samsung Galaxy. Looks very, very similar to the iPhone. Apple decide they want to sue Samsung. Okay, so the outcome of the litigation might not have been settled before the year end. So it's an unknown amount, and it's conditional on the judgment as to whether or not Samsung infringed patents belonging to Apple. Okay, so that's legal action. There might be income tax disputes. So there might be disagreement between how much has been paid in income tax by the company and how much the ATO or the tax office was expecting in terms of payment. There might be warranties that are expected to be processed or registered by individual customers, and so on and so forth. So in terms of treatment, if we deem the contingent liability to be possible, then we want to have some sort of note disclosure. Right? If we think there is about a 50-50 chance, then we want to make it known to shareholders that we expect a liability to be paid out. However, if it's probable, meaning we're about 80-90% sure that we're going to have to make some sort of payment, then we expect to make an adjustment to the financial statements. So we're going to incorporate that as a financial statement account. Right? So we're going to include a liability for a legal settlement expense or a product warranty expense. Okay. So possible is when is a 50-50 chance of the outcome occurring, and probable is more closer to 70 or 80%. Right, so these are our procedures for dealing with contingent liabilities. Right? Liabilities we expect to be recognized in the future. Okay. Commitments, on the other hand, commitments are considered less liabilities, but they're considered a future obligation for some sort of transaction. Okay? So we might have signed a contract, for instance, to purchase raw materials. Okay? While that isn't usually a bad thing, right? It can be, I guess, less advantageous to the company if there is a change in the circumstances of the market. Okay, so say you're a jeweler, okay, and you want to buy gold from a supplier. So you set the price to buy gold at, say, $1,500 an ounce. Okay? So the contract itself is fine because, let's say, the market price is $1,500. But if towards the end of the year, the price of gold drops to $1,200, right? You're paying pretty much a $300 premium to purchase gold now, right? Because you've agreed on the contract. So the commitment we want to recognize as potentially a note if the commitment is not favorable to the company. Okay? If we're buying gold at a better price or a lower price than the actual market value, then we don't need to disclose that, right? It's simply how the company operates. But if we have a commitment that is negative in nature, meaning we're expected to pay more because of this agreement, then we want to disclose this. But of course, it's only a note disclosure, because these are events that haven't happened yet. We've agreed to a contract to buy gold, for instance, or lease facilities at a certain price, maybe above what is usual. But this hasn't actually happened, so it doesn't require an adjustment because we haven't actually paid in the agreement. Okay, so how would we actually identify contingent liabilities and commitments? So we can either inquire of management, so management should disclose whether or not they believe some contingent liabilities or commitments exist. We talk to the ATO if we believe that there are tax issues. We look at the minutes of meetings. to see what they discuss. And we might look at the legal expense. So why is the company actually seeking legal counsel? Is it for a particular reason? Okay, so these are contingent liabilities and commitments. So you're required to identify these and include them on the financial statement if they will affect decision making, right? If they will affect how shareholders perceive the company. Okay, learning objective 3 is to obtain and evaluate letters from the client's external legal counsel. Okay, so if we want to figure out the likelihood of any litigation or any potential litigation claims, we need to seek legal counsel of the client. So I talked to Amanda earlier this week, and she said that we need to emphasize standards a bit more, because in past weeks, we haven't really talked about the specific standards behind each of the topics we talk about. Okay, so starting this week, I'm going to put a bit more emphasis on the standards. Okay, so especially when we get to audit opinions, be very conscious of the standards we are using. Okay, and in some cases, you'll need to know the paragraphs that you want to be referencing. Okay, so for litigation claims under ASA 502, we want to obtain a lawyer's representation letter to ensure that we have incorporated all of the potential legal expenses or events that might occur into the financial statements. So the lawyer's representation letter is requested by the auditor. So the auditor says, okay, they talk to management saying, we want your legal counsel to tell us about any potential legal proceedings that might occur and the outcomes, or the potential outcomes. So management will then prepare and send off a representation letter or a lawyer's letter to their lawyer, telling them, can you please inform the auditor of any legal action that is expected to occur. The lawyer then sends this letter directly back to the auditor. And so the auditor inspects this and to identify whether there are any outstanding legal cases or events that need to be incorporated on the financial statements. However, legal counsel might be reluctant to provide all of this information because there might be a lack of knowledge about these matters. If this is a very early stage legal proceeding, then the lawyer will not be particularly, I guess, knowledgeable about the likelihood of the outcome. So they might be less willing to provide detailed information about the case, especially if some of it is sensitive to ongoing proceedings. There might be a refusal to disclose due to confidentiality. So if it relates to an ongoing case or a case that has not even occurred yet, but the lawyers are aware of it, then they'll be less willing to disclose this to the auditor. And communication might not be privileged, meaning the auditor simply doesn't have the right. So the key thing is we only want to report on legal events So we want to report only on legal events, proceedings that have commenced. Meaning that if someone has actively filed a complaint against the company, or the company has actively filed a complaint against the third party, then that requires disclosure on the financial statements. Okay? So the lawyer might be aware of future litigation, but they're usually not willing to tell the auditor, right? Because these are case-sensitive matters. Because if they tell the auditor and the auditor discloses this information, this may subject the client to greater legal liability. Okay? So let's say when Samsung were developing the S6, okay, before it was released, right, Apple wasn't going to sue because they weren't aware of the product. But I'm pretty sure the lawyers at Samsung were aware of the fact that Apple was probably going to sue once they released the phone. So they probably weren't willing to tell the auditors that we expect to be sued by Apple because the next product we release is going to be very similar to the Apple iPhone. Okay, so we only want to report on legal proceedings that have already commenced. Learning objective 4 requires us to conduct a post-balance date review for subsequent events. Okay, so subsequent events is one of the big topics this week. Right, because subsequent events, we always need to be aware of them as we conduct the audit. Because up until the point that we sign the audit report, every event before that, we need to report on. Right, we need to be aware of. Okay, so subsequent events occur starting at the beginning of the balance sheet and ending at the date of the auditor's report. Okay, so this will be, say, the 30th of June. Usually for an average company. And the audit report, for example, will be signed most commonly 90 days after, so let's say the 30th of September. Okay, of course, the time varies depending on the auditor and their expected time to complete procedures. So within this 90 or so day window, any event that occurs, we need to be aware of, and we need to report these events if they impact year-end balances. Okay, we need to report them if they impact year-end balances, meaning that one of the financial statement accounts is now different as a result. Okay, so those events that have a direct effect on the financial statements require adjustment, meaning that they impact year-end accounts, balances. Okay, so these events will require an adjustment in most cases. So think, for example, about a bankruptcy of a major debtor. Okay, so at the year end, we expected to collect money from this debtor, and so this was recorded as accounts receivable. So if it turns out that after the year end, this debtor goes bankrupt, we are unlikely now to collect the full amount of accounts receivable. So we need to discount the accounts receivable to reflect this bankruptcy. Okay? So this bankruptcy relates to an event or condition that existed at the year end. The condition being that we expected to collect money from this debtor at the year end. But it turns out that this debtor went bankrupt, and now we need to adjust for that. Okay, so the condition being that we expected to collect money from this accounts receivable debtor. So for the second scenario, the settlement of litigation at a different amount. Okay, so the existing condition is that we've recognized on the financial statements that we expect to pay out a certain amount for litigation. But now, because of the outcomes of the legal proceedings, we expect to now pay out more or less. Okay. So we need to adjust for this in the financial statements, okay, in the legal expense or the legal expense provision. Right? We need to adjust for this because we have an existing condition, a legal case that is ongoing, that turns out we expect to pay out more or less based on events that have happened after the balance date. And last but not least, for the disposal of equipment below the current book value, right, we have a piece of equipment recorded at usually cost, depreciated to a carrying amount. If it turns out we sold this piece of equipment below book value, we need to adjust for that because it means that at the year end, we were likely to sell it at this value, right? It means the equipment itself was overvalued, right? So without a reliable market value, we assume that this was the true value after year end of the inventory, of the equipment on the balance sheet. Okay, so we need to adjust this down as well. Okay, so the existing condition meaning we have equipment, and so once we sell the equipment, if it turns out the value is lower, we need to adjust for that. So these are direct effect events subsequent to the year end. Okay, so then there are events that have no direct effect, meaning these are new conditions. Actually, it's already there. So these are conditions that didn't exist at the date of the financial report, and they require disclosure, meaning notes, to the notes. So we want to say in the financial statements, in the notes, that this happened after the year end. It doesn't affect the balances, but it's relevant. So these are the types of events that have no direct effect on the year-end balances. So if the market value changes of a set of securities that the company owns, okay, this does not require an adjustment because we assume that the securities at the year-end were at the correct market value. It's a matter of the market value changing, okay? Meaning that after the year-end, the market value changed, might be lower, might be higher. But it doesn't affect the year-end value because we relied on the correct market value at the year-end. Now, after year-end, we might have also issued bonds or shares. Okay, so if it's after the year-end, then it doesn't affect the financial statements because these events happened after the year-end and don't affect the year-end balances, right? Equity is still correct at the 30th of June. It's just after that, it's changed. A decline in market value of inventory. So this is an interesting one. So if it turns out we sold inventory for less, then that may constitute a direct effect. But if the market value has changed, then it's a subsequent or indirect effect, or no direct effect. Because the market value we might have correctly accounted for at the year end, but it's a matter of the market value changing after the year end. Okay? So it doesn't affect the 30 June balance. We might have lost inventory from a fire. So provided this fire didn't start before the 30th of June and was extinguished after the 30th of June, this would be a no direct effect. Meaning that at the 30th of June, all of our inventory was fine. So we reported that correctly. It just happened that on the 1st of July or the 2nd of July, there was a giant fire that wiped it all out. Okay? At the 30th of June, there was no fire, inventory was fine, so the balance was correct. It just so happens that after the 30th of June, there was a fire, and the inventory was wiped out. And last but not least, a merger or acquisition. So if a merger or acquisition commenced after the year end, then it's a no direct effect, because the financial statements at the 30th of June still reflect the fact that this company is its sole entity by itself before the merger. Okay, so these are types of subsequent events. So next week we will be covering that in more detail in the Learning Catalytics quizzes. Okay, so it's highly recommended that you actually watch the subsequent events video that that is in the folder already for this week's lecture. Okay, so what are the types of tests that we might want to conduct to figure out these subsequent events? So it's just a matter of talking to management, talking to lawyers, looking at internal records and statements after the balance date. You might want to consider meeting minutes. You might want to show up to directors' meeting minutes, sit around, see what they say, and pick out any events that may be relevant that occurred after the year end. And we might also want to obtain written representation from management to have them clarify any events that have occurred after the year end. Okay, learning objective 5 is to design and perform the final steps in evidence accumulation segment of the audit. Okay, so these are two of the key steps in final evidence accumulation. So once we've conducted all our procedures, we're happy that either the internal controls are working and we're relying on them, or the internal controls are rubbish and we've done our own testing. We then want to perform the final analytical procedures, just to review to see if there are any outstanding misstatements that we haven't adjusted for yet. And we want to identify any unusual fluctuations that still exist. Being that once we require some sort of adjustment, that will change the balances within the accounts, right? So as a result, we might see new fluctuations occur after we require adjustments during the audit. So we're going to pick out any unusual fluctuations still present and investigate those. So once we're happy with the financial statements being fairly consistent, we can move on. We then want to evaluate the going concern assumption. Okay, importantly, this is under ASA 570. Okay, so every year, the auditor needs to assess whether or not they expect the client to continue operating for the next 12 months. Okay, so they're going to conduct analytical procedures, run ratios on the liquidity and the solvency of the company, and decide, will this company continue to operate? Right? Because one of the bases of the financial statement is that we prepare the financial statements with the expectation that we're going to pay back all our debts within the next, due within the next year. So we're not going to go bankrupt. So as an auditor, we want to make an assessment of whether or not we think the client will continue. Okay, so there's a flowchart diagram in the explanatory material of ASA 570 that's worth looking at. Right, very useful in the exam. But the conditions for our going concern assumption will depend on the severity, how likely the company is to fail, and the level of management disclosure on the issue. Right? So if it's very severe that management have disclosed, we might be a bit more friendly. In cases where it's highly improbable the entity will continue as a going concern, we're going to issue an adverse opinion, saying we do not think the financial statements are prepared on the basis of going concern. But we do not think the client will pay back its debts within 12 months. Okay, so the severity ranges. So highly improbable is probably the worst. Right? We expect 80 or 90% that the company will fail. So then there is significant uncertainty. So this will be a lot more common. So with significant uncertainty, we can have two treatments. If there is disclosure by management of this significant uncertainty, then we have an unqualified opinion. With emphasis of matter, or if we have no disclosure, so I'll make this a bit clearer in a second, then we want to issue a qualified. Okay, so the most severe stage of going concern is improbable, where we expect that the client will fail very, very shortly. A less severe stage is significant uncertainty, meaning we're about 40, 50%, at least 50% sure that the client is going to go under. Okay, if management willingly disclose this information, then you can issue simply an unqualified with emphasis of matter, saying, okay, we believe that the financial statement is correctly prepared, but we'd like to emphasize that management have disclosed the fact that they don't think the company is going to survive over the next 12 months, or the company is less likely to survive. If the company refused to disclose this, if management say we refuse to tell our shareholders that we are unlikely to survive, the auditor then issues a qualified opinion saying, the financial statements are correct, except for the fact that we don't think that the company is going to exist in the next 12 months. Okay. However, so that's the treatment if there's significant uncertainty. So if we're more than 50% sure, then we're going to say there's significant uncertainty about the company's future. Highly improbable simply requires an adverse opinion because we say the financial statements are completely wrong because they should be prepared on a liquidation basis. Okay, so ASA 580 requires written representations, and I guess the bulk of this, or in short, this shifts legal liability. Right, so the basis of a management representation letter is to have management agree or admit that they were in charge of financial reporting, they were in charge of ensuring the completeness of information, that management were in charge of the recognition, measurement, and disclosure of this information, of the financial statements. They were aware of the risk and uncertainties in the financial statements and subsequent events. Okay, so we have management sign that, so we can say, okay, we are not in charge of that, management are in charge of that, so if you have a problem with that, take it up with management. As an auditor, we've done our job. Okay, so that's a management representation letter. So towards the end of the audit, they will obtain that statement from management and incorporate that into the financial statements to shift some of the blame the other way. Okay, so this is different from a management letter, which we'll cover shortly. Okay, learning objective 6 is to integrate the audit evidence gathered and evaluate the overall audit results. Okay, so to evaluate our results, right, we need to make 3 assessments. So the first assessment we make is the sufficiency of evidence. Do we believe we have enough evidence to draw an opinion? Okay, so I'm going to link this into audit opinions. So if you don't quite understand what these opinions mean, don't worry because I'm about to go through them. So do we have enough evidence to draw an opinion? That's sufficiency. If insufficient, we want to issue a qualified or disclaimer opinion. Okay. So we're going to make an assessment as to whether or not we have enough information to make this assessment. Okay. So quite often the auditor might be missing information to make important judgments, being that there might have been records that were misplaced or records that were lost. Management might have simply refused to give the auditor records to specific accounts for whatever reason. Maybe they were sensitive. All right, so if we deem that we don't have enough evidence to draw an opinion, we might issue a qualified or disclaimer opinion. And I'll talk about which to issue in which situations shortly. Okay, so if we know we have enough evidence to make an opinion, then we determine whether or not the evidence supports the auditor's opinion. Okay, so we want to summarize the misstatements uncovered. So we want to say that if the actual is greater than the tolerable error, tolerable misstatement, sorry, then we might want to issue a qualified or adverse opinion. Okay, so we want to decide, once we have enough evidence, whether or not that evidence is consistent with what we expected as an auditor. So for those of you that have been to the tutorial, right, we look at whether or not the actual misstatements we find exceed the expected level. If they do exceed the expected level, then we're going to request an adjustment. If management refuses to make this adjustment, then we issue a negative opinion. All right, so we want to see whether or not the evidence supports the auditor's opinion. So the auditor believes that accounts receivable should be 10 million, management record accounts receivable of 15 million, then there's a discrepancy, right? That requires a different opinion. And then we have financial report disclosures. So are the financial statement disclosures correct or consistent? So again, if not, you want qualified or adverse. Okay. Okay, so I might want to summarize that with the last 2 points, we're talking about disagreements with management. Okay, so these 2 scenarios, misstatement being exceeding the tolerable and financial report disclosures being inadequate. This is the auditor and management disagreeing on the treatment. Okay? Because the auditor, as soon as they uncover material misstatement or uncover disclosures that should be made or should not be made, they will immediately tell management. It is up to management to decide whether or not they want to incorporate these disclosures. If they do, then the financial statements are correctly prepared, right? No qualification. If they are not, then the auditor issues a negative opinion. All right, so that's results. That's evaluating results. So based on the sufficiency of evidence, level of misstatements, and disclosures, we're going to issue a different opinion. Okay, in terms of evaluating our results, we also want our results reviewed by a third party, by another person within the audit firm. because we want to make sure that our report does not have any sort of errors or misstatements that we ourselves forgot to detect in the report. All right, so every single week, Amanda and I will go through the lecture slides, and she'll prepare the lecture slides, and I'll make sure that there are no major faults or errors within the lecture slides. So, right, having this second set of eyes look on the reports or the working papers ensures that we'll pick out any misstatements or errors in the reports that the preparer forgot to correct or didn't see. Okay, learning objective 7 is to communicate effectively with the audit committee and management. Okay, so when it comes to communicating with the audit committee and management, they want to make very clear any irregularities, whether or not there is fraud or other illegal acts. So the moment we're aware of a client or management engaging in any sort of fraud, we want to report that immediately. There might be significant deficiencies in internal controls. So we're going to report that to the management as well, right? Because we want them to be aware of the problems in their internal controls. So we consider this a value-added type procedure. So we've either relied on the internal controls or we haven't. But regardless of which, we're still going to report on them and tell management about what is working in their internal controls and what is not working, right? Because management still want to be aware of this, because they'll still use the internal controls for financial reporting, for internal decision making, and for achieving their own objectives. So we still want to communicate any deficiencies in internal controls. We want to talk about independence requirements. Have we met the requirements for auditor independence? That being that we don't have any financial interests in the client. We're not in any way related to key management personnel, etc. And that will all be contained in the management letter, where we tell management specifically, or the audit committee, the details of the audit. Okay, in terms of other communication, we might also talk about the overall scope of the audit and the limitations, so what we were able to do during the audit, what we were not able to do. We'll talk about what policies were selected and which policies are most important or relevant to the engagement. And we'll request audit adjustments whenever we're unsure, whenever we disagree with what management have estimated as the correct value. Okay, and we'll prepare all of that in the management letter, which tells the client about their operations, what is deficient and what's not, and what's working properly. Okay, learning objective 8 is to identify auditors' responsibilities when facts affecting the audit report are discovered after its issuance. Okay, so here we are focusing on all events we become aware of after we've signed the audit report. Okay, so after we sign the audit report, let's say on the 30th of September, our legal liability is largely discharged, meaning we're no longer responsible for what happens next. Okay, but we also need to be aware of subsequent events after the signing of the audit report that effectively occurred before we signed the audit report. So after the auditor issues the audit reports, the audit is finished, but the auditor becomes aware after the audited financial statements have been issued that some information included in the financial statements is misleading. They may want to reissue. So it's only relevant if event occurred before report signing. Okay, meaning we're only concerned about facts or events that occurred during our audit or before we signed the audit report, but we found out after we signed the audit report. Okay, because the auditor's duty to continually be aware of what's happening in the company after the 30th of June, up until the point they sign the audit report. After that, it's no longer their responsibility. But if they find out that, say after the 30th of September, let's say in December, that a client, that a debtor went bankrupt, but the debtor went bankrupt during the audit, then there needs to be an adjustment or a reissue, right? Because the auditor should have known about that bankruptcy. Okay? If the event happens after the signing of the audit report, and it's a whole new event that didn't exist before the signing of the audit report, then there is no issue. Okay, so now we're going to move on to audit reporting. Okay, so this is when we actually look at the specific treatments of our findings. So what are we going to do in terms of reporting once we know the outcome of the financial statements, whether or not they are or are not materially misstated? Okay, so our learning objectives, we want to describe the nature of and the need for the auditor's report. So the audit report is based on the need to comply with the Australian accounting standards. So we set the standards. So the standards are set requiring that all listed companies prepare an annual report that is audited to shareholders. Right? So that's the basics of the audit report. Moving on. Learning objective 2 is to specify the conditions that justify issuing a standard, unmodified, meaning there is no qualification or emphasis of matter, audit report, and we want to describe that report. Okay, so to issue an unmodified report, meaning there is no qualification, no adverse, no disclaimer, and more importantly, no emphasis of matter, we need to ascertain the following. So importantly, ASA 700 in the standards requires that we have reasonable assurance. So reasonable assurance is sufficient, appropriate evidence. Okay? That's what it means to have sufficient reasonable assurance. It means we have sufficient appropriate evidence, enough reliable evidence to be reasonably sure of our result. Okay? So in order to provide an unmodified report, we need to have enough evidence, first and foremost, right, to have reasonable assurance. We then want to make sure that the financial statements are free from material misstatement. So that means no issues in policies, estimates, or disclosures. Okay, that's what we mean by is free from material misstatement, meaning that we believe that the client used the correct accounting policies, their estimates are consistent with our estimates, and they have the correct amount of disclosures or the right disclosures relating to the financial statements. Okay, that's what we define as free from material misstatement. We also want to make sure that they are consistent with the applicable reporting framework. So in this case, we'll say AASB. Right. So their treatment of inventories, of revenues, of payables, of related parties, that is all correctly accounted for in the financial statements. And there is a fair presentation. So what we are saying is that there are unbiased disclosures, meaning management have fairly presented the financial statements. There is no particular emphasis on favorable areas, right? The financial statements use a generic format which do not highlight or emphasize positive or negative aspects more than others. Okay? And it's in accordance to the Corporations Act, which set out its own rules. For instance, we require, under the Corporations Act, a rotation of audit partners. So a new audit partner was on the engagement. Okay, so to issue an unmodified audit report, meaning that there are no issues in the financial statements, we have enough evidence to say that there are no material misstatements. The financial statements follow the accounting framework. There is fair presentation of the annual report, meaning that there are no biased disclosures or information. And we follow the Corporations Act. Okay, so that's the basis for issuing an unmodified audit report. Okay, so what information will we see in an audit report that is unmodified? There'll be the title of the audit report, the addressee, who we're addressing, shareholders of the company, the introduction, which is fairly bulk standard. So you'll see, if you go onto UTS online, there'll be a whole bunch of examples of audit reports. Use the exact same terminology start to finish. They talk about what management is responsible, what the auditor is responsible. They issue the opinion, which is what we're focusing on today. So is it unmodified, unqualified, qualified, etc.? A signature saying that they endorse this opinion, the date of when the report happened. So this is when the auditor discharges their liability, and the address of the auditor, in case you want to complain to someone. So these are the parts of the unmodified audit report. Learning objective 3 is to describe the statutory audit reporting requirements of the Corporations Act. So the statutory requirements require, as we talked about, compliance with accounting standards, so AASB, require that there is a true and fair view. So all companies will use the exact same format in terms of the annual report to disclose their financials. The auditor's independence declaration, the auditor says that they are free from any bias. We notify ASIC if there are any situations that occur. And we report the consolidated accounts, meaning we have the company and we have all their subsidiaries included on that annual report. Okay, so that's the requirements under the Corporations Act. So in this subject, we're not overly concerned about them, but when it comes to financial reporting, these are considerations, right, for publicly listed companies in Australia. Okay, learning objective 4 and 5. We want to talk about the two conditions requiring a departure from an unmodified or unqualified audit report. So when are we going to issue something that is not unmodified or unqualified? And we want to talk about the three types of opinion that we might have. Okay, so under ASA 705, so you've noticed the cute little octopus, I'll get to that. So there are three types of opinions that are modified, meaning we have placed some sort of emphasis on missing information. So there is a qualified, disclaimer, and adverse. So the first condition why we might issue a modified opinion is that the financial report is materially misstated. So this means, as I highlighted before, policies, estimates, or disclosures differ. Right, meaning the auditor expected a certain policy, a certain estimate, and a certain disclosure on the financial statements, and quite simply, management disagreed. Okay, actually, I should probably call it a disagreement. Actually, no, I'll highlight that a bit later on. Okay, so it's a policy, estimate, or disclosures that differ. We would disagree between what management report and what the auditor estimated. Okay. And on the other end, there is an inability to obtain sufficient appropriate evidence. So evidence limitations. Meaning we can only tell so much from the evidence we have. Meaning we don't have enough evidence on certain accounts or assertions. Okay, and the opinion we issue depends on the severity of the issue. So there are two types of opinions, the two types of severity. There is material but not pervasive, and there is material and pervasive. Okay, so the example that Amanda always uses every semester is this octopus. Okay, so if there is a pervasive misstatement, it's like an octopus, meaning that its tentacles are everywhere, right? It's all over the place, right? We have one call error that branches out and affects all these other accounts, right? We've got all these tentacles going all over the place. So let's say our revenues are overstated by 25% or 30%. This will feed through to accounts receivable that is now overstated. This also feeds through to gross profit, net profit, retained earnings, right? And now the company is a lot more profitable because of this misstated revenues, right? So that is considered pervasive. So this is this guy I like to call Perry the pervasive octopus. Okay, so Perry the pervasive octopus says that the financial statements are now wrong. We're going to make the wrong opinion of the financial statements because of this error, right? It will completely change the way we think. Okay, so Perry the pervasive octopus tells us that one error that is big enough will completely change our opinion of financial statements. Okay, so this is Amanda's little creation. Okay, so I thought I should bring my own little creation to this, right? Because Amanda has this octopus she uses every semester. I figured I may as well. I'm going to be around here long enough. So in order to describe material, I've defined who I call Norman, the non-pervasive slug. Okay, so what Norman represents is a material but not pervasive misstatement. Meaning Norman, sits on one particular account and won't get too far away from that account, right? It's stuck on, say, accounts payable, right? It might have the accounts payable might have a small effect on inventory, but is largely isolated, okay? That is material but not pervasive, meaning that our overall judgment of the financial statements is the same, right? We make the same conclusion, but there is one account that is overstated by more than we're willing to accept. Okay, so we can contrast the two now. It's material if we see, and not pervasive, if we see one issue that is isolated by itself, right? We have, we've recorded the accounts payable balance is too low by about 15%. Right? That's largely isolated to liabilities, right? There isn't a huge effect on the overall financial statements. All right, so that's Norman the non-pervasive slug. Whereas Perry, the pervasive octopus, right? We might have sales revenue incorrect by 30 or 40%, right? That will change the overall financial position of the company. Okay, so based on the scenarios, we're going to have different opinions. So if it's one isolated issue, we have a qualified opinion. Right? One isolated issue where we have an account being misstated, simply qualified. Or one account where we don't have enough evidence, qualified. But if this is one big account which affects the overall financial statement performance, it becomes adverse if there's material misstatement, or it becomes a disclaimer if we're lacking information. Okay, so these are the two different types of animals that reflect the concepts of material and pervasive under ASA 705. Okay, learning objective 6 is to explain how materiality factors into audit reporting decisions. Okay, because at the end of the day, materiality defines what is materially and not materially misstated. Okay, so if you remember back to a few weeks, we talked about materiality as being an omission, misstatement, or non-disclosure that will affect or adversely affect decisions about the allocation of scarce resources and the ability of management to discharge their accountability. Right? It's because management all of a sudden are now responsible or have done something wrong. Okay, so that's materiality, right? We have an inaccuracy in the financial statements that will change how people perceive the company and its performance. Okay, so as we talked about, immaterial is when decisions are unlikely to be affected. So we use the threshold that if the account is less than 5% materially misstated, then it's unlikely to affect our decisions. We issue an unmodified opinion. Material is when decisions are likely to be affected for that particular account. Right? So if you were to make a specific judgment about accounts payable, and accounts payable is materially misstated, then that's going to change our opinion, right? If we're focusing on that. So if we're worried about debt covenant and accounts payable as part of it, then it becomes qualified. Pervasive is when most or all decisions are significantly affected, meaning we've completely changed our opinion of the financial report and the performance of the company because of this material misstatement, or this pervasive misstatement. Either because we're lacking information or the information that the management have presented in the financial statements is wrong. So we issue an adverse or disclaimer. Right. So pervasive is a very severe sort of level of error. Right? We're talking about whole sets of accounts missing, or profit being overstated tenfold. Okay, learning objective 7 is to look at modified audit reports under a variety of circumstances. So you'll find this on UTS online of real companies, so I won't talk too much about that. Learning objective 8 is to focus on when an emphasis of matter is appropriate. Okay, so when do we need to draw attention to the financial statements? To certain disclosures on the financial statement. So an unmodified audit report with an emphasis of matter is appropriate when an audit with satisfactory results is fairly presented, but we want to draw attention or provide additional information. Meaning we want to highlight disclosures made by management. Meaning management have talked about their going concern issue. Management have admitted that we have a huge debt facility that we may not be able to service. So they say that in the financial statements. If the auditor thinks that is very important to shareholders, they will again say, if you refer to management discussion about the going concern. So we contrast this against a qualified opinion where management refused to disclose this. So if management say we do not want to talk about our going concern issue, then it becomes a qualified. Okay, so we have an unqualified with emphasis of matter if management agree to talk about the problem and the problem is significant, and we issue qualified if the problem is significant but management refused to disclose this in the annual report. Okay, so we have an emphasis of matter paragraph when management have disclosed all relevant information, but we want to highlight that particular piece of information as being important. So what are the types of things that we want to talk about? So we can talk about additional disclosures. So one note might be particularly important. So management might talk about a potential buyout of a smaller company, right, in their notes. The auditor might want to highlight that. Going concern is an important one, where management might agree to say that they may not be able to pay back their debts, and we want to emphasize that. The auditor might want to talk about inconsistent information if they see it, but management want to keep it the way it is, and any revisions to the financial report. Okay, and I'll also very briefly mention this new standard called ASA 701. So ASA 701 requires the auditor to talk about key audit matters when they highlight and say, okay, we believe that this was important to the engagement. This was particularly relevant to our audit this year. So it's a brand new standard, and there are no actual examples because it starts on the 31st of December 2016, meaning that all annual reports released in 2017 will include this key audit matters paragraph. So why do we have this? We want increased transparency, meaning we want the auditor to tell shareholders about the financial statements a bit more. Because right now, all that we have is a yes or no, qualified, unqualified, and why. There is no explanation of why it is unqualified, right? There is no discussion of it is unqualified, but we had issues with these particular accounts, okay? So, quite simply, we want to address areas of higher assessed risk of material misstatements and significant auditor judgments and the effect of significant events. So we want to highlight these particular things. It doesn't mean the financial statements are wrong, but it means that these were important to conducting the audit. Right? We paid extra attention to something, to say intangibles, because they were particularly relevant. Okay, so that's ASA 701. That's comes into action next year. Okay, so this will be communicated in a paragraph under titled Key Audit Matters in the audit report. So the potential issue we have is the boilerplating of these types of disclosures, meaning that auditors may simply make the exact same statements year to year. So it may not be that informative if auditors are not, I guess, they don't provide relevant disclosures in the key audit matters, meaning that they simply talk about the exact same accounts year to year. So what we want to see is the auditor highlight different problems every year that they want to be concerned about. So that's the issue we have with boilerplating, meaning that the auditor simply talks about the exact same issues. So every auditor has the exact same issues with, say, intangibles or related parties. So if they're continually talking about that exact same disclosure, that exact same issue, it's not going to be very informative. Okay, in terms of takeaways, what we want to ensure is that you understand how to deal with subsequent events. So we want to you want to know when to do nothing, note disclosure, or adjustment. Okay, so you need to be very clear as to when to do each of these things, okay, when it comes to subsequent events. With going concern issues, you want to know, is it uncertainty or probable? Okay, you need to make a decision as to whether or not you think it's simply uncertainty that the client will fail, or it's probable the client will fail. And is there disclosure? And last but not least, we want to talk about relevant auditor opinions. So there is unqualified with EOM, bless you, qualified, adverse, and disclaimer. Okay, so these are predominantly the 5 types of opinions that you will be required to issue. So this is for one specific event. It'll be one of these 5, right? You have a combination with emphasis of matter with the other qualifications if there are multiple events occurring. Okay, so these are the most important factors coming out of this lecture. So do we have any questions? All right, if not, guys, have an excellent day and week. And Amanda will be back next week for revision. Thanks, guys.